I personally still believe that we have some weakness in the labor market, and we just saw that with the most recent BLS jobs report. That was a pretty big miss. But leading up to that, more recent data over the last couple months has shown strength and resilience in the labor market. And so what we have is these Fed members who have been fairly vocal still. Now, I think that that's going to tail off over time, because I don't think our new Fed chairman is going to be a huge fan of these Fed members getting on their soapbox and, giving their opinion on what they think is going to happen. I think we'll see less of that. It's not going to go away completely. But we have a number of Fed members. If you look at the dot plot, you see this evidence there, and you just see it in the headlines. They're out there talking about, there's going to have to be more Fed rate hikes. The futures market's still anticipating Fed rate hikes here in 2026 as opposed to future cuts, and just multiple comments from the Fed. So there's just so much turmoil from the Fed. They're very hawkish right now. But I think a lot has changed since these comments were made just 2 weeks ago. The Iran war is essentially over. Now, I say that, and then this morning I hear that, a couple missiles were shot at oil tankers going through the Strait of Hormuz because, they were a little bit off the path that they were supposed to take through the strait there. So, there might be little flare-ups here and there. The market didn't have a significant reaction to that. We'll have to see how that plays out. But look, as long as oil prices stay low, then I believe mortgage rates will get there. I think it's going to take a little bit of time, as it often does. And I never said that it wouldn't. It just might, it might take a little bit of time for it to get there. But what we're seeing right now, based on the last BLS jobs number, is, I think that the overall sentiment is the labor market is stronger than we were thinking. There was talk before that the Feds may have to cut rates simply because of the weakness in the labor market. I think that's subsided, but I also don't think it's strong by any means that would lead them to have to hike rates. But really, it's been the ongoing inflation talk as we've come through this massive spike in oil prices. So this next Fed meeting that we have is going to be very interesting to hear what the tone is. Because now that we have, at least a semi-permanent resolution, it appears, to the conflict in Iran, what are these hawkish Fed members going to say? Are they going to change their tune a little bit about their concerns with inflation as a result of oil prices now significantly coming down? Because that's what they've been pointing to over the last couple months as it relates to why they've been so concerned and feel like the Feds may need to hike rates. So, we just had a recent weak jobs number. I think, there's more confidence in the labor market than there was, but it's still not super strong. And I think most people that are forward-looking, including our Fed chairman, Mr. Walsh, understand that AI and the impact of AI is going to bring more productivity and put pressure on the labor market over time. Not too dissimilar to what happened with the advent of the internet and, back in the late 90s. So, we've been down this road before. It's not exactly the same as AI, but, history, doesn't always repeat itself, but it does rhyme, as they say. So I think we have a similar situation coming up there.